You don't hack the stock market because you're greedy. You hack it because you're bored, and because the market is, at its core, just a system. And you have never in your life encountered a system you couldn't find your way inside. You're 26. You have a master's degree in computational mathematics from a university that cost your parents everything they had. You work at a mid-size quantitative trading firm in Chicago, building algorithms that predict micro-movements in stock prices. You are very good at your job. Your job pays you $94,000 a year. The algorithms you build make the firm $40 million a year. You've done that math. Everyone at your level has done that math. Nobody talks about it out loud. The vulnerability you find isn't in the market itself. It's in the communication infrastructure between three major trading exchanges, a latency gap, microseconds wide, created by a routing update that one exchange pushed 6 weeks ago without fully notifying the others. What this means, in practical terms, for approximately 11 milliseconds after certain high-volume trades execute on exchange A, the price data, visible on exchanges B and C, lags behind reality. In those 11 milliseconds, you can place trades on B and C that are effectively guaranteed to profit, because you already know what price is coming. 11 milliseconds. Most humans can't perceive 11 milliseconds. You've built a system that can execute 400 trades inside 11 milliseconds. You test it with $50,000, money you've saved over 3 years of careful living. Over 4 trading days, the $50,000 becomes $340,000. You stop. You sit with $340,000 that didn't exist a week ago and think about what you've just done. Then you do it again. Over 9 months, the $340,000 becomes $200 million. You are not reckless. You scale slowly, carefully, spreading trades across 14 accounts in 6 jurisdictions, varying timing and volume to avoid pattern detection. You hire no one, you tell no one. You live in the same apartment you've always lived in. You drive the same car. You eat the same lunches. The $200 million sits in accounts you can access, but don't spend. Because spending it would require explaining it, and explaining it is not something you're prepared to do. You are, on paper, a mid-level quant analyst making $94,000 a year. Inside a spreadsheet only you can access, you are worth $200 million. The gap between those two numbers is the most dangerous thing you've ever created. The moment everything changes is not dramatic. It's a Tuesday afternoon. You're reading a financial news article about market microstructure anomalies, academic, technical, the kind of thing only people like you read, and buried in the third paragraph is a reference to an SEC working group that has been investigating unusual latency correlated trading patterns across 3 major exchanges since the previous spring. Since the previous spring, you've been running since the previous winter. They're not looking for you specifically. They're looking for the pattern. But the pattern is yours. You built it. You know exactly what it looks like from the outside because you designed it to be invisible. And now you're reading a description of it in an SEC report described as a sophisticated and coordinated exploitation of infrastructure timing gaps. Sophisticated and coordinated. 2 people wrote those words about something one person built in an apartment in Chicago while eating cereal for dinner. Here is the thing about $200 million that nobody tells you. It is not freedom. It is the most complicated problem you have ever had. You can't spend it. You can't move it cleanly. You can't give it back, not without confessing to how you got it. You can't keep it. Not indefinitely, not with an SEC working group publishing quarterly updates on the investigation. You can't do anything with it except watch it sit in accounts that are, every day, slightly closer to being found. You spend 6 weeks thinking. This is what you decide. You are going to give it back. Not because you're noble, because the math says it's the only exit that doesn't end with a federal prison sentence long enough to consume the rest of your functional life. The question is how. You can't wire $200 million back to the exchanges. That transaction alone would trigger every financial monitoring system on the planet simultaneously. You can't donate it. Charitable donations above certain thresholds trigger IRS reporting that would trace directly back to your accounts. You can't convert it to cash. The physical logistics of $200 million in cash are quite literally impossible for one person to manage. What you can do, what you spend 4 months carefully, methodically doing, is this. You identify every trade that generated illegitimate profit. You calculate, to the cent, what each counterparty in each trade lost as a result of your timing advantage. You build a restitution model, the most precise accounting document ever created for a crime nobody has officially accused you of committing. Then you begin returning it. Not in one transaction, in thousands. Small corrections distributed across accounts, structured to look like routine settlement adjustments, the kind of micro-corrections that happen constantly in high-frequency trading environments and attract no attention whatsoever. It takes 14 months. You do this while continuing to work at the firm, building algorithms for $94,000 a year, sitting in the same desk, eating lunch from the same places. By the end, $194 million has been returned. The remaining $6 million, transaction costs, currency conversion losses, the friction of 14 months of careful misdirection, is gone. Your net gain from the most sophisticated individual market exploitation in the history of American financial markets is negative $6 million. You are 28 years old. You are exactly as broke as you were at 26, minus 3 years of savings. The vulnerability you exploited has been patched, quietly, without public announcement 6 months into your restitution process, suggesting the exchanges found it themselves. The SEC working group published a final report 14 months ago concluding the anomalous patterns had self-corrected and closing the investigation. Nobody knows. Nobody was ever charged. Nobody ever will be, because the crime has been so precisely undone that the only evidence it happened lives in a spreadsheet on a laptop that you have already destroyed. You sit at your desk on a Tuesday morning. You open the algorithm you're currently building, a routine momentum predictor, standard work, the kind of thing that makes the firm $40 million a year. You make $94,000 a year. You've done the math. Somewhere in the infrastructure of 3 major trading exchanges, there are 14 months of micro-corrections that nobody has connected to anything. A restitution that looks like noise. A $200 million crime that balanced itself down to the cent and then disappeared. You are the only person alive who knows it happened. You will probably always be the only person alive who knows it happened. The question you ask yourself on Tuesday mornings now is not whether you could do it again. You know you could. The question is something smaller and harder than that. Was returning it the right thing to do? Or just the safe thing? You haven't figured out the difference yet. That wraps it up for today. This story is entirely fictional, but high-frequency trading vulnerabilities and latency arbitrage exploitation are documented and ongoing concerns in global financial markets. If you had $200 million that nobody knew about. Would you give it back? Drop your honest answer below. Subscribe for more. See you in the next one.